Okay. All right. So we'll start with our income statement. And these are the accounts we have. Oh, wait a minute. I got the wrong one. Let's see. Okay. There's an autofocus, but it's not called autofocus. It's called something else. Anyway. All right. So start out with the revenues. Sheet here, and this is the one that says revenues on it. So this is money coming in. So income statement just says what comes in. So these are all money. This is all money coming in, and this is all money going out here. So revenues are coming in, expenses are going. All right, expenses. That's the other way. And they're kind of in jumbled up order here compared to the first one, but here's the. I was looking for things that say expense on them. Now I'm going to put this in as a negative because it's money going out. That's what we pay to our employees. It's pretty high utility expense, but so revenues are what came in. Expenses are what goes out. And what's left over is our income. And hopefully what comes in is more than what goes out. Time for Mr. Calculator. Turn the calculator on. That's a tip. Turn the calculator on first. Then it's so much better. All right, 10,250. Right spot. And again, these are throughout the year. So your year, whatever, I don't know what a year on here, but whatever year you'd have. So if this is 2020, throughout the year we'd have this amount of sale, and throughout the year we'd have these amounts of expenses, and then this would be how much we made for that year. The next year we'd start over at zero. These would all go back down to zero. We'd start over, and as we sold stuff and paid employees and so forth, it would just keep going up. Okay, so that is how much money is coming in. We go over to the statement of retained earnings, which is really the kind of the owner's piggy bank. Retained earnings starts out with the most obvious account for that statement, retained earnings. And these are just, this is money that they made that they haven't taken out of the business. It's still in the business. So we'll have beginning. So that's just that. Beginning retained earnings. And where's my little fizzy drive? And you recall, income goes into retained earnings, dividends come out. So it's kind of like the excuse me, the owner's piggy bank. And that when you make income, it goes into the piggy bank. More money for the owners. They take it out. Well, they've taken out some of the money, so this piggy bank's smaller. Okay, so so we come back here. So we have this net income of 10,250. That's going to go into our piggy bank. The owners had 12,500 in there. They added another 10,000. I'm sorry. Apologies. Honestly, I didn't know my phone was down here. All right. I'm in the basement, but all right. So this is income is 10,250. Make sure I get the right number there. 10,050. The owners took some money out of the place, and they take money out with dividends. So these cash dividends declared of 1,000. So that's the owners taking $1,000 out of the piggy bank. They're taking $1,000 out of retained earnings. So these are kind of net income is the same as the earnings. So this is really earnings, and then they've taken some out, so they're no longer retained. They removed those earnings. So this goes in and okay, so 10,250 went into the piggy bank. And took out 1,000. is left in the piggy bank. Okay. 12,500 plus 21,750. So that will be my ending retained earnings. And the 71,750, this is the most that they could take out of the company. If this goes down to zero, then they can't take out any money. So if they're going to pay out dividends, they have to have. It's like what's like your piggy bank. Take the piggy bank. If the piggy bank's empty, you can't take anything out of it. Same thing here. So any retainer. So this is the most that they could have. This is what they have in the piggy bank. It's the most they could pay out in dividends. 21,750. Okay, down here, assets. Is there anything that has a value? Is our assets. So if they have a value, it's a U. Looks like a valve. If you have a valve, it's an asset. A valve would be an asset. Liabilities. These are what you owe other people. Or the business owes other people. And equity, these are the owners. So this is anything of value. This is when we borrow money, we owe other people, and then down here is the owners. Okay, so let's take a look at our up a little bit. Hey, oh, that's fine. Okay, so our assets are anything of value. The obvious one here is cash. Cash has a value. Highlight that with something. See which color I didn't use. So cash is an asset. Put that one in. The one here that's not obvious whether it's an asset is this one on here. We know accounts payable from last time. If you got to pay somebody, this is a liability. This accounts receivable is when somebody owes us money. So when someone owes the business money, an accounts receivable. Now, this accounts receivable, when they pay it, is going to be turned into cash. So accounts receivable is an asset. So let me write something here just to clarify the difference between receivables and payables. Anytime you see receivable or receivables, it's going to be an asset. Anytime you see payables, it's a liability. So receivables, you're going to receive. This money that's going to come in. It's always going to be an asset. Payables are money you're going to have to pay out. It's always going to be a liability. So receivables, asset, payables, liability. No matter what they are, it could be interest receivable, rent receivable, whatever. It's going to be an asset. And same thing with payables. Interest payable, liability, interest, just draw a blank. Whatever, you gotta pay a mortgage payable, loan payable, whatever, it's gonna be a liability. So any payable is gonna be a liability. Okay, so we have receivable here, so we're gonna put that in. If I can fit it in here, we'll try. Came close. All right, so 20,000. And that is it for the assets. So 5,000, don't even need the calculator for this one. 20,000 plus 5,000 is 25,000. Okay, moving over to liabilities, we just talked about here, any payable. Here we have a payable. So we owe 12,000, excuse me, $1,250. Let's see, accounts payable. That's it for the liabilities. I'm just total them down here. I'll see total liabilities. If you only have one, you don't really need to do this, but I'm doing it anyway. Okay, so that is how much they owe. We'll make that orange. How about that? Okay, going down to the equity section. This common stock, I know it's tempting to put that in as an asset, but this is actually common stock that is was sold to the owners. If this were stock you bought in another company, it would be an asset, but it would be called an investment. So because this is not called an investment, it's called common stock. It's going to be in the owner's equity section. I know that's not obvious, but that's just kind of the way they do it. So sometime in the past, the owners paid the company for stock $2,000. And it might sound like a small amount, but they may have done this 20 years ago. So, it may have been a much smaller place when they did that. Okay, so the common stock always goes in the equity section. Let's write that in. How about? So common stock is always going in the equity section. All right. So the owners have their account that they said we paid in $2,000 into this place. However, they also have their piggy bank, their retained earnings. This is money that also is the owner's money. This will come down here. Okay, so this is ending retained earnings. $21,750. So the owners paid in money for stock. They also earned some money that they haven't taken out of the place. So this is the total equity of those two. Calculate for this. 23,750, right? 21,750 plus 2,000, 23,750. So the total liabilities are 1,250. The total equity is, oops, need a zero. Total equity is 23,750. So we add those two together, 23,750 plus, and that's 25,000. And you'll notice that these two balance, this is a public balance sheet, they equal. And so you, oops, get that out of the way. So you might say, well, why? Why do they equal? Well, this explains where all these assets came from. Assets just don't appear out of thin air. They got to come from someplace. So in this case, they borrowed $1,250. The owners kicked in another $23,750. That's how they got those assets. So the balance sheet really explains how we get those assets. How do we get the assets? In this case, they borrowed $1,250. The owners kicked in the other $23,750, and that's how they got $25,000 worth of assets. Okay, let's go to. Then again, you guys, you can use the notebook if you'd rather. Probably more convenient to use a notebook. Put your answers in the notebook. That's fine. Just just number them. So this would be number 4. It's a lot easier than printing them all. A lot cheaper than printing them all too. Okay. Whoa, this one's got a bunch of stuff on it. Well, I guess we just jump right in. There's a couple of them that are a little bit different than we've seen before, but talk about. Let's do the easy one first, the revenues. They're nice and easy. So here's the revenues. That one in. This is color coordinate that. So revenues are 41,400. So that's the money coming in. Now, when it comes down here to the expenses, utility expense, repair expense, those are fairly user expenses. This cost of goods sold is also going to be in with the expenses. Let me write that out. And yeah, maybe now is a good time to talk about cost of goods sold. This is going to come up in later chapters. Mortgage payable, liability. I think it's a payable to be a liability. Yeah, but that is a new one. Inventory is a new one too. Well, we'll get to those in a minute. But the so cost of goods sold always going to be with the expenses, and cost of goods sold is sort of like this. Let's say I buy one. I don't know what do we have. We bought one toy car for $6. Sold the toy car for $10. Oops, I put 10,000. That's a little high. I'm sorry. So let's say we sold the car. So you buy a toy car for $6, we sell it for 10. This is what that would look like. The revenue, the money coming in would be the $10. And the cost of goods sold would be $6. So the cost of goods sold it's not cash leaving the place, it's actually inventory leaving the place. So it's just another way of saying the same. If I told you this, you bought a car for $6 and you sold it for 10, you know immediately how much you made on it. But putting it into our kind of accounting format, the revenue would be the money coming in, 10, and the cost of goods sold would be the car going out. We paid $6 for it, and now it's leaving. So cost of goods sold are the goods going out. We're going to have a whole chapter on that later on. Okay, so let's put these in here. So cost of goods sold. Utilities expense. So nice, but utilities. Let's see here. Let's go ahead. Utility expense, 9,200. repair expense. Okay, so this is what came in. This is what went out. This is actually inventory going out. This is cash going out. And then what's left over is made. And we need Mr. Calculator for this. $11,960. I'm going to do that again just to make sure. Yep. Okay. And the reason I did it, if this is wrong, you'll notice something. If this is wrong, this side's not going to balance. This thing's not going to balance on the other side. So that's why, you know, especially if you have a whole bunch of numbers, not a bad idea to check them again. I'm going to do something really quick here. I'm moving my phone because my phone is interfering with my speakers. I'm getting noises from my speakers. I don't know if you guys can hear that, but it's annoying to me, so probably is annoying to you too. All right, so this is how much money they made, and again, this is what came in, and these are all what went out. In this case, it's inventory that went out, and these down here are cash going out, and so this is what was left over. And what came in is more than what went out, which is what we like. So, and again, I think I mentioned this last class. You hear in the news and stuff a lot of times they talk about revenue. The revenue is actually not the most important number; it's the income. You know, you had 41,000 of revenues, and you had 50,000 of expenses. That'd be terrible. So the income is really your, you know, this is literally the number you're going to focus on when you look at a business, see how well they're doing. Okay. Page 2, Piggy Bank. Start out with retained earnings. So retained earnings. The next thing we need is the income from the previous page. Oops. So this is money going into the piggy bank. By the way, you'll also notice something here. when you're doing these, you kind of have to do them in the order that we're doing. You know, here's the first one. You gotta start with this because you need to have the net income before you can do the statement of retained earnings. So until you get this number, you can't do this one. So this is the second one. And you'll also notice the retained earnings that we bring it down here. So you have to do this one before you can do this one. Sometimes our students jump into the balance sheet and say it doesn't balance it. Well, you have to do this first. Actually, you have to do income first, then this, and then go with that one. Okay, dividends. Dividends were there. So cash dividends declared $1,840. So that will be money they took out of their piggy bank. No, cash dividends declared. Okay. So 23, 1, 2, 3. That was wrong. Try it again. Oh, I think I put minus instead. So they added 11,960. The piggy bank took out 1,840, and so this is the ending. We're now here to assets. Okay. Assets we have. We'll make them purple. So assets are anything that has a value. All right. So here are going to be the assets. Cash has a value. Inventory is valuable. Equipment has a value. Payable is a liability. All payables are liabilities. And I think that's it for the assets. Okay. So 9,200. 5,000. Okay. So those will be our assets. $51,520. up again just to make sure. Yeah. All right, so 51,520 is the total assets. Coming over to our liabilities. Anything of the payable is going to be a liability, so we have this accounts payable. And our mortgage payable. So anything that's payable. So accounts payable, we owe someone money. Mortgage payables, obviously we have a mortgage. Okay, so here, total liabilities. Would be those two together. 300 plus down to equity. Common stock 4,600. Again, common stock is always equity. But we also have, the owners also have these retained earnings. All the way down here. Okay, so this will be our total equity. Plus 13,800. So these two equal, obviously, and this explains, you have 51,520 of assets. You borrowed 13,000, or the business borrowed 13,800, and the owners kicked in 37,20. Question on that? Okay. I think we're going to do a couple problems out of the book class and do the practice test. Why don't you hold on to this? Because some of you, if you're doing it on the sheet here, on these here, this is kind of like a layout for the problems we'll be doing. So let's not turn anything in. So we'll call it a class, and next time we're going to do a couple of textbook problems. And next week we'll have the turning everything in next time. So these would be problems we're going to do out of the textbook, and yeah. So hold on to this, and we will turn it all in next week. Any question on that?
So everything we just did this week, we turn in next week. That's it.
Yeah. This handout will be turned in next. You don't need this first page in the handout, but everything, this other stuff, pages 2 through 6.